In this video, Tesla stock moves higher, Elon Musk drops an epic hint for Tesla stock investors, and a new article discussing Tesla, innovation, and the so-called competition. So Tesla stock moved higher again today, closing at $842.70 per share, up over 2%. To put this in context, in the last 5 days, it hasn't really gone anywhere, up 1.65%. However, over the last 1 month, up almost 25%, last 6 months, down 10%, and year to date, down about 30%. This is volatility in action. Over the last 1 year, Tesla stock up almost 25%. Now, here's something to ponder, ladies and gentlemen. I know this shouldn't have an impact on the price of Tesla stock, but notice, at the end of July 2021, Tesla stock was around $670 or so per share. Fast forward a little bit to November, it was over $1,200 per share. What do you personally believe will happen? And again, this isn't a prediction, I'm just asking, what do you think might happen to the psychology of some investors when they start looking at the 1 year chart for Tesla stock, give or take around October or November this year, when suddenly we're not starting from a base of $670 per share, but over $1,200, meaning if in early November 2022, Tesla stock is around the same price as it is today, about $840, over the preceding 12 months, we'd actually be looking at a stock down 30% rather than up 24%. This is something to keep in mind. It wasn't long ago that Tesla stock was effectively up about 1% over the last 12 months. That didn't last long. Just something to keep in mind. I've got a funny feeling there'll be a few investors out there who start looking at Tesla stock and rather than paying attention to what the company's been doing recently and what the future looks like, they just look at the 1 year chart and go, wait, what? It's down 20% over the last year? Huh? That doesn't make sense. I might buy some. Today, the Nasdaq 100 was up 1%, Apple stock up 1/3%, Amazon stock up 1%, and absolutely vertical after hours. Clearly, the stock market liked their recent earnings. Alphabet stock, Google's parent company, up 1% today. Rivian stock up almost 6% today. Lucid stock down 1% today. Nikola stock up almost 8% today. And ARK's Innovation ETF down 0.5%. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks. Check out the links in the pinned comment below. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. You can also pick up some Tesla, Elon, and investment themed merch in the merch store, so check out the links in the pinned comment below, and thanks for your support. And now on to Elon's epic hint for Tesla stock investors. He tweeted this an hour ago. Inflation might be trending down. Following up, quote, more Tesla commodity prices are trending down than up for what it's worth. So let's talk about this. Elon Musk has exposure to huge portions of the global economy through SpaceX and Tesla, never mind his other companies as well. Tesla and SpaceX, between the two companies, doing business, producing products on multiple continents globally. Elon has his finger in a lot of pies, so this is worth paying attention to. Take with a small grain of salt, but it's definitely an interesting data point. Given that more Tesla commodity prices are trending down than up, this suggests that more of Tesla's costs overall are trending down versus up. We know Tesla's been massively increasing prices across the range on their products over the last 18 months, mostly due to insane wait times, but also in part in an attempt to proactively adjust and maintain approximately the same margins as they have previously despite increasing material costs. So if the trend overall is now headed down, but wait times are still ridiculous, this to me suggests that prices may actually start to stabilize even if costs are coming down, meaning Tesla's margins may actually start to increase fairly dramatically. If they didn't have ridiculous demand and absolutely obscene wait times, I'd expect prices on the products to start coming down too. However, we know the wait times are absurd, absolutely ridiculous, so what choice do they have? If Tesla starts lowering prices because their costs are coming down, wait times are just going to blow out even further. In short, this to me indicates Tesla's margins are going to get a massive boost over the medium term because they're not going to be able to drop prices in line with the reducing costs. Stay tuned for that. Tesla owner Silicon Valley asked, are prices for a Tesla going to increase? And Elon responded, too early to say for sure. Now, why would you be asking about prices increasing when Elon's saying that costs are coming down? That would be the EV tax credit. Discussed this in yesterday's video, so I'm not going to rehash that. But I do actually think prices are more likely to be heading up then down over the next 12 or so months. That's despite Tesla's costs coming down. And now onto the meat and bones of today's video, a great article I came across this morning entitled "Chasing Tesla, There Is No Catalog." If you want to follow along, there's a link in the description of the full article. We'll just run through some of the highlights. In chapter 5 of their book, The Innovator's Solution, Clayton Christensen and Michael Rayner wrote that managers must ask, quote, "What do we need to master today, and what will we need to master in the future in order to excel on the trajectory of improvement that customers will define as important?" As I said, we're running through some highlights here, so if you guys want to pause along the way and soak up some of these graphics, I do recommend it. It'll add a lot of important context, but I don't want this video to be 6 hours long, so let's move on. The authors use the example of IBM as a cautionary tale against outsourcing activities that, quote, might seem to be a non-core activity today, but that might become an absolutely critical competence to have mastered in a proprietary way in the future. Consider, for example, IBM's decision to outsource the microprocessor for its PC business to Intel and its operating system to Microsoft. IBM made these decisions in the early 1980s in order to focus on what it did best: designing, assembling, and marketing computer systems. Given its history, these choices made perfect sense. Component suppliers to IBM historically had lived a miserable, profit-free existence, and the business press... we'll talk more about, I know where this is going already. Shout out to the likes of CNBS. Competition is coming. Anyway. And the business press widely praised IBM's decision to outsource these components of its PC. It dramatically reduced the costs and time required for development and launch. And yet, in the process of outsourcing what it did not perceive to be core to the new business, IBM put into business the two companies that subsequently captured most of the profit in the industry. How could IBM have known in advance that such a sensible decision would prove so costly? More broadly, how can any executive who is launching a new growth business, as IBM was doing with its PC division in the early 1980s, know which value-added activities are those in which future competence needs to be mastered and kept inside? Now, at this juncture, I'm sure many long-term viewers of the channel know exactly where this article is going. If you're not putting two and two together yet, don't worry, that's what this article is for. Let's continue reading. IBM's decision to outsource chips and operating systems to Intel and Microsoft has resulted, many decades later, into it being dwarfed by those rivals in market value. As we can see here, market capitalization in billions of dollars. Intel plus Microsoft, about $2 trillion, and piddly little IBM there at $116 billion, about 5% of the combined market cap of Intel and Microsoft. This chart is incomplete, of course, because it doesn't include Intel's own struggles with adapting to a changing landscape of integration and modularity. Intel itself is dwarfed by TSMC, by the way, that's a chip manufacturer, which is valued at $438 billion currently. The authors contended that in early markets, in our example the electric vehicle or EV market, the quote, product functionality and reliability are not yet good enough to address the needs of customers, and therefore companies must employ proprietary vertical integration, since using modular components, quote, takes too many degrees of design freedom away from engineers, and they cannot optimize performance. Case in point, some highlights from a Munro and Associates teardown of Ford's Tesla killer, the Mustang Mach-E.
If you look at the back, because it's a heat pump system, the lines run in an exact straight line. When comparing and contrasting to the Ford Mustang Mach-E, you'll notice that the lines are not nearly as concise. So Ben, do you want to go ahead and grab the first component to compare, and we can talk through the differences?
All right, well, first we're going to grab all the lines that the Mach-E has, which is, as you can see, a whole bunch of lines when compared to what the Tesla Model Y had. There's actually 35 different hoses here, which is a very large number when looking at the thermal system.
I got a funny feeling these guys had to stop themselves from using the word clusterfuck repeatedly. What we're seeing here is Ford using off-the-shelf components. The challenge here, as the article illustrates, if the engineers are constrained, they're having to use off-the-shelf parts and components, they're not inventing, they're not actually engineering, this is a kind of absolutely embarrassing clusterfuck you end up with.
Get the weight just in the fluid. If you aren't going to get range if you can't get rid of weight. And I need efficiency when it comes to wiring and plumbing. This is where things start to fall apart on the Mach-E. But bear in mind, this is the second best product that we've looked at. That's ponderous, isn't it? This is better than everything else that we've seen apart from Tesla. This is better than everybody else.
So what was that about? Using modular components, taking too much freedom away from engineers, therefore they can't optimize performance? We definitely didn't just see an exact example of that in the EV industry, did we? Moving on. We are witnessing this struggle between integration and modularity play out in the auto industry. Like IBM in the early 1980s, traditional OEMs such as VW, Government Motors, and Ford are good at, quote, designing, assembling, and marketing, and perform very few functions in-house. Very few people, I think, will truly understand how little today's large automotive manufacturers actually do. I hate to say it, but most of them are effectively glorified window dressers. They take a bunch of shit that other people make, cobble it together, slap a logo on it, and then spend billions of dollars every year trying to convince consumers that it's better than anything else on the market. The shift to electrification and autonomy, however, shifts the basis of competition. Many suppliers and components simply do not exist. In its Q3 2020 earnings call, Elon Musk called the modular approach of incumbents, quote, catalog engineering. And again, I refer back to the absolute clusterfuck we just saw, the Mark E thermal management system. It looks like a fucking bowl of spaghetti. The reason for so many hoses and connections is because instead of engineering a thermal management system from scratch, the engineers just ran through their catalog. Oh yeah, okay, we need this bit and this bit and this bit. And you end up with an absolute clusterfuck. It's inefficient, it adds an unnecessary weight and mass, therefore you lose range, and it's just a joke. I mean, an actual joke. It's embarrassing that Ford put this in a vehicle and sell it to customers. Now, a customer won't notice this stuff unless they tear down their own vehicle. But the company will notice this stuff in decreased profitability and or no profitability and or a waste of resources and or inferior performance versus the size of the battery pack and so on. It's not good. The industry evolved towards catalog engineering over 100 years of innovation and consolidation. But in the new basis of competition, there is no catalog. As most people watching this channel will know, Tesla is absolutely vertically integrated compared to other auto companies or basically any other company. We have a massive amount of internal manufacturing technology that we built ourselves. By the way, this doesn't just apply to physical products, components and parts, but also software. Tesla has their own corporate software. They've written their own corporate software. They've written their own software to control their factories, the robots, everything. Tesla does so much in-house that most investors, most consumers have no idea about because it's not relevant to them. But it is relevant from a business point of view and more importantly from a Tesla stock investor's point of view. Elon from the earnings call continues. This makes it quite difficult to copy Tesla, adding that Tesla isn't actually opposed to companies copying Tesla, just that it's quite difficult because you can't do catalog engineering. You can't just pick up the supplier catalog. I'll get one of those machines, one of that machine, bingo. Now I'm Tesla. There is no catalog. What catalog? So we made the machine that made the machine that made the machine. And yeah, for those of you who are unaware, Tesla has literally invented many new machines specifically to meet their needs because no machine existed prior to that. They needed something to exist. Okay, well, is there a machine for that? No. Okay, well, we'll have to make the machine to build the machine to build the machine. Elon continued. But yes, it's like we're just making a crazy amount of machinery internally. Tesla is not well understood. If you just walk around the factory, you'd get a sense for it. And yes, I don't know if this is like a smart move, but I just know like, hey, if we're trying to make progress and nobody's got the machines that we need, we've got to make it. So we do. Meanwhile, General Motors, Ford, or so on, they go to a supplier, oh no, we can't make that machine, that doesn't exist. So what do? Well, they just go cry in the corner and suck their thumb. Meanwhile, Tesla's like, yeah, we'll just have to make a new machine. The dearth of adequate suppliers has forced Tesla into vertically integrating various aspects of its business. It builds its own factories with an internal team seeking to optimize floor layouts, continuous motion production, the amount of factory volume, and by the way, we're not just talking to one dimension here. Elon in the past has talked about the volumetric efficiency of factories, trying to use every square meter, every square foot, whatever your unit is, not just on one plane, but all the way up to the roof lines as well. This is a massive work in progress, but this is Tesla's ultimate goal. It has its own custom silicon for autonomy. It has created its own proprietary lithium cell form factor, 4680, and manufacturing process. Again, I've talked about this in the past. Tesla's like, you know what? Industry leading batteries today, they're fucking shit. Let's make better batteries. Yeah, okay, we'll do that. Next minute, they do that. Next minute, they have created the best battery cell on the planet and are now giving these plans to other battery manufacturing companies saying, hey guys, here's our design, just copy it, we need them, thanks. But remember, Tesla is just a car company. It sells direct to consumer, eschewing the traditional layer and lost profits of the stealership franchise model. It does advertising internally, through Elon Musk, that is. There are no outside ad agencies and Tesla doesn't advertise because it doesn't need to. It recently launched Tesla Insurance, which is already, this is insane by the way, the second largest insurer of Teslas in the state of Texas, saving customers money and making them safer through real-time behavioral feedback. Tesla even built its own enterprise software, ditching SAP as far back as 2013, a decade ago. SAP, a German company, counts VW as a customer. Tesla has proven that it can build the most modern cars in the world, and apparently Elon Musk insisted they build their own IT systems and e-commerce platform too. I'm going to skip ahead a little bit. The short story, Tesla couldn't find anything in the marketplace to suit their needs. They're like, fuck it, we'll just write our own enterprise software. And they did. Modularity eventually wins, right? Another quote from the book. Modularity has a profound impact on industry structure because it enables independent, non-integrated organizations to sell, buy, and assemble components and subsystems. Whereas in the interdependent world, you had to make all of the key elements of the system in order to make any of them. In a modular world, you can prosper by outsourcing or by supplying just one element. Ultimately, the specifications for modular interfaces will coalesce as industry standards. When that happens, companies can mix and match components from best-of-breed suppliers in order to respond conveniently to the specific needs of individual customers. Ben Thompson, however, has shown that this model is incorrect. The reason is that the authors rely on businesses making purchasing decisions, not customers. When it comes to customers, good enough doesn't exist. They are, in the words of Jeff Bezos, divinely discontent. Incumbent automakers are not standing still. That's right. They're running backwards. Get it? Because, let's not go there. So far, it is not working out. Internal combustion engine vehicle sales continue to melt down. A lot of the sales declines shown below stem from supply chain issues, but ICE volumes have declined consistently for years now. As I've discussed in the past, a lot of these OEMs are hiding behind all the supply chain challenges. That's why we're not selling shit. That's a very marginal factor. Once the global supply chain challenges have alleviated, these companies are going to have to find another excuse as to why their sales are continuing to decline by double-digit percentages quarter after quarter, year after year. The reason is clear. EV adoption, okay? The ICE vehicle's dead. I've been saying this for years. It's been obvious for years. Yet these companies publicly claim, oh, it's just supply chains, that's all. Give it 12, 18 months, see what they're saying then, when their sales are still down 10, 12, 15, 35%. Oh, it turns out consumer preferences have changed faster than we could have anticipated. We're looking at US sales by OEM in the first half of 2022 versus the first half of 2021. Can anyone notice the discrepancy here? There's one company with positive growth in the US. An 89% increase, that company would be Tesla. They only sell electric vehicles. Meanwhile, let's just read these numbers for context. Ford sales, down 7%, BMW down 11%, Daimler down 12%, Hyundai down 14%, Stellantis down 14%. The total automotive industry, the average, down 17%, Geely down 17%, Subaru down 17%, Government Motors down 18%, Toyota down 18%, Mazda down 20%, Nissan down 30%, Volkswagen down 32%, Honda down 38%, and Tata down 45%. This to me looks like disruption. Meanwhile, incumbents' EV sales are still minimal, although they are spending furiously to catch up with Tesla. By the way, the whole spending furiously thing, I want to talk about this. I've made this point in the past, but if you guys really want to do some homework, again, I don't want this video to be super long, so I'm not going to go through every single one of these numbers. Look at the lifetime cost. Tesla's total capital raised in the history of the company. In other words, how much money has it cost Tesla so far to get to where they are today as a business? And compare that tiny number versus the truly staggering amounts that legacy automotive manufacturers have either already spent on EVs or committed to spending transitioning to EVs. You will be stunned. As a result of its vertical integration, Tesla currently enjoys the highest operating margins of any OEM. And we can see this in the chart from Tesla's Q1 report. Tesla's operating margin in red, already industry leading and continuing to trend up. Rest of industry going absolutely nowhere. In addition to catalog engineering, quote, I'll get one of those machines, one of that machine, bingo, now I'm Tesla. OEMs are also trying to convince investors. This is so funny because it's true. OEMs are also trying to convince intellectually challenged investors that their businesses will be transformed into fast-growing, high-margin copies of Tesla. By the way, the convincing is working. The fucking stock market, I mean, honestly. Legacy OEM comes out. New press release. We're going all in on EVs by 2079. Next minute, the stock doubles overnight. This is basically what's happening. A lot of talk, zero walk. They're all going bankrupt. Investors, however, in general, seem oblivious to this fact. Oh yeah, we're going to copy Tesla and we're going to get the same results as Tesla, therefore you should buy our stock because it's better value than Tesla. Next minute, morons do exactly that. In its latest earnings report, Government Motors forecast higher growth and higher margins. Again, if you want to pause this and look at some of the absolute horse shit, feel free. I'm not going to waste my time on this. Margins of 12 to 14% by 2030 are still below what Tesla achieved in early 2022. But 50% annual growth is, what a coincidence, exactly what Tesla has promised and so far delivered on. Meanwhile, VW believes that by throwing money at the problem, it will become, quote, the second largest software company in Europe, only after SAP. Dees, by the way, rip Herbert Dees, and by extension, rip VW. The guy's just been fired. Many of you will be aware of this. I called this a couple of years ago. I saw it coming, writings on the wall. Diesel's going to get fired. He's speaking too much. He's saying too much that's true. He's trying to do too much to help VW survive going bankrupt later this decade. He's saying the right things, doing the right things, and knows what needs to happen. And he has the courage to actually say out loud what needs to happen, and that VW are behind, and they need to catch up to Tesla, and it'll be difficult, and ultimately he's going to get fired, and of course now he's been fired. This will not age well for VW. Diess organised VW's software efforts into an autonomous unit called Cariad. Cariad has its own profit and loss statement, as it will provide services for all of VW's disparate brands, and in exchange, receive revenues from the software license fees. This is pretty hilarious. I mean, think about this for a moment. VW, clusterfuck of an organisation, it's got its own branch in terms of software, and it's going to be charging licensing fees to itself effectively. It's just, I mean, I understand why. The structure is just an absolute mess. Way too many chefs in the kitchen, and this is the end result. It's an incongruously modular approach from a company trying to become more integrated. Keyword trying. There is a lot of trying going on at the moment. Skipping ahead a little bit, long story short, VW software, absolute clusterfuck, taking longer than expected, costing more than expected. And here I was thinking that in order for a legacy automotive manufacturer to beat Tesla, they just needed to, get good at software, which is easy, right? And start making EVs. That's easy as well, isn't it? It's hard to think of examples of incumbent companies that have been successful in changing their cultures and developing the new musculature required to beat focused startups operating from an entirely new set of principles. Great point. One wonders if VW's vision of becoming the largest software company after SAP will resemble the software efforts of JP Morgan. For years, JP Morgan's CEO has touted the size of their developer workforce. This is hilarious, by the way. Back in 2014, JP Morgan's CEO was bragging about JP Morgan having nearly 30,000 programmers, aka software developers. 30,000. By that measure, JP Morgan has been a larger software business than either Alphabet or Microsoft since at least 2014. Shitty Group is another example. By the way, last I heard, I think their price target from the Wall Street analyst covering Tesla stock was about $300 a share. Shitty has over 30,000 software engineers. Nuts. And again, I mean, it's like bragging about how inefficient you are. You have more software engineers than Google or Microsoft, yet the results to show for that. Despite their armies of developers, these banks still can't match the agility and user experience offered by startups such as Square, now Block. This is fair. How successful will OEMs like Volkswagen be in catching up with Tesla's software prowess, particularly when they must navigate a thicket of obstacles like trade unions, total death sentence, family factions? By the way, if you guys are curious, VW, look into the ownership structure. It's just an absolute clusterfuck. And even the local government, which owns an equity stake in the company. Yeah, for those of you that don't know, this is actually true. If you look at who owns and has a say in VW, it is a recipe for bankruptcy. The latest frontier of vertical integration for Tesla is lithium refining. In all of Tesla's earnings calls, Elon Musk has used the term print money twice. The first was in 2019 when he explained that installing solar tiles in California is a no-brainer. The second time was this month when he talked about the margins available in lithium processing. Skipping ahead a little bit, on the call, Elon said lithium's everywhere. The lithium refining business right now is ridiculous. It has software-like margins. It's literally a license to print money. Elon has been taking his own advice. 2 years ago, Tesla got into lithium refining. Elon's been banging the drum on this for a while. We also learned that Tesla had a patent for their own process for extracting lithium, I believe, from spodumene. Could be wrong on that one, but the point is, Tesla figured out a way to basically chuck some table salt into some mud, and next minute you extract lithium. Seriously, why would Tesla be looking at inventing and patenting techniques for extracting/refining lithium? Yeah, good question. I have no idea why they would be doing that. Currently, China dominates lithium refining capacity. By the way, there's a difference just for those who don't understand the terminology. Mining is pulling the shit out of the ground, out of the earth. Refining is actually getting all the other crap out, so you've just got lithium left over. These are two separate processes. Sometimes they get a bit conflated. What we're looking at here is a forecast for 2025 output and refining capacity in metric tons. I mean, just tons. These forecasts suggest an enormous amount of lithium mining happening in Australia, about twice as much as the next largest country. However, there's a very big mismatch in terms of refining. For example, in China, lithium mining in China about 150,000 metric tons, yet refining over 1 million, meaning much of the lithium mined on other parts of the world is ending up in China for refinement. But Musk wants to change that. From Tesla's Q2 2020 earnings call, quote, vertical integration is extremely important for this, but the supply chain, if you put a GPS tracker on a molecule from where it got mined to when it was in a usable product, it would look insane. It would look like, wow, it went around the world like 6 times. So with vertical integration, maybe you can only go around the world once. It would be a huge improvement. Rather than the molecule going around the world even once, Tesla wants to mine lithium in Nevada and refine it in Texas. And as I mentioned earlier, it has even filed a patent on a novel way of refining lithium using table salt rather than the current method of acid leaching. Regarding lithium refinement, extraction, mining and so on, here too, Musk would like others to step in and lower prices. But as he concluded in the Q2 2022 earnings call, quote, "If our suppliers don't solve these problems, then we will." Meanwhile, pick your other company, especially an automotive manufacturer, will just cry in the corner and say, "Oh, we can't do anything. It's not our fault. Sorry. If we go bankrupt, but don't blame us. No one did this for us, so it's not our fault." And if, in the process, Tesla discovers that it can create proprietary methods, such as its novel approach to refining, it will also get to keep the financial rewards of vertical integration, along with the benefit of staying a step or more ahead of its modular competitors. Sooner or later, they too will discover that there is no catalog. I found this article fascinating. It touches on a lot of important points. Key among them, Tesla, the most vertically integrated automotive manufacturer, using the term loosely, on Earth by miles. In fact, one of the world's most vertically integrated companies, period. Tesla does just about everything they possibly can in-house. And if they encounter an obstacle, oh geez, we can't make this, it doesn't exist yet. What do? They just invent a new machine or a new technique. Whereas just about everyone else goes, oh, well, we're stuck, aren't we? We can't do anything, so we won't do anything. Next minute they go bankrupt. And things tie together quite nicely. As we saw Elon's tweets earlier this morning, he's actually seeing on average overall costs starting to come down on some of the commodities, some of the parts and components. This could put downward pressure on Tesla's costs. But to be clear, I don't think prices are going to come down because, as I discussed, with already ridiculous wait times, even if Tesla's cost to produce vehicles does come down, if they lower prices at this point in time, wait times just get even more ridiculous. It's not reasonable and they won't do it. Long story short, Tesla's profits, their gross automotive margins are going to go to the fucking moon, in my opinion, in the coming 6, 12, maybe 18 or so months. And just about every single legacy automotive manufacturer today making empty promises to their investors. Oh yeah, we're going to catch up to Tesla. We're going to become a software company. Our profits are going to increase. Are either ignorant, unlikely, or blatantly lying, misleading and deceiving investors. I'll leave it up to you folks to determine which is which, but I am on the record once again, the vast majority of legacy automotive manufacturers will not survive the decade. They will either go bankrupt, approach bankruptcy, and then merge with a number of other companies into a huge conglomerate, which then itself eventually goes bankrupt, or they'll be acquired by companies when the exact same thing happens. All roads lead to bankrupt if you're not Tesla. Now, there will be a couple of exceptions, but I'm not smart enough to know which those will be. So in general, I think the short story is, if you're Tesla, great, and if you're not, you're fucked. Hope you guys and girls have enjoyed the video, and lastly, don't forget to join Patreon with the card in the corner or the link in the pinned comment. You'll gain access to my Tesla stock price targets over the next decade in the bear case, the base case, the bull case, and the hyper bull case, plus dozens of exclusive pieces of content, over 100 Q&A videos, and loads of other content and perks. So I'll see you over on Patreon. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.